In 1907, no Federal Reserve, no New Deal. Chaos ruled Wall Street. Wall Street was a wild, untamed place with no central bank and minimal regulatory oversight. This was the year of the Panic of 1907, a financial crisis so severe it threatened to bring down the entire American banking system. P. Morgan played a crucial role in stabilizing Wall Street during a financial crisis. We'll discuss how the crisis began, how it spread, and what measures Morgan took to mitigate the damage. By the end, you'll understand why this event was a pivotal moment in American financial history. The crisis begins. The Panic of 1907 began with a small banking firm called the Knickerbocker Trust Company. It was run by a man named Charles T. Barney, who had made significant investments in speculative mining stocks. Barney had taken out substantial loans from other banks to finance these risky investments. But when the value of those stocks began to fall, the loans created financial difficulties for the firm. One day, worried depositors showed up at the Knickerbocker Trust Company, demanding their money back. P. Morgan for help. However, Morgan was not interested in bailing out the institution's risky investments. As a result, the bank could not pay its depositors and a run on Knickerbocker began. Within days, the bank was forced to close. The ripple effect. The failure of Knickerbocker Trust Company sent shockwaves through the financial system. Other banks and trust companies became wary of their risky investments. Depositors rushed to withdraw money from these institutions, causing a domino effect. Banks that couldn't meet these withdrawal demands also failed, further destabilizing the market. One of the hardest-hit institutions was the Tennessee Coal, Iron, and Railroad Company, TCI, a major player in the coal and steel industry. TCI faced financial difficulties during the panic and was unable to meet its debt obligations. This crisis affected the coal and steel industries, as companies struggled to obtain the capital necessary to continue operations. P. Morgan takes charge as banks and businesses started to fail. Panic spread across Wall Street. People feared a total collapse of the financial system. P. Morgan stepped in. Morgan was already a powerful figure in finance, known for his practical approach and ability to solve complex problems. Morgan quickly realized that the key to stabilizing the market was to ensure that the Trust Company of America, TCA, didn't go bankrupt. He negotiated with the company's creditors and arranged for TCA to be acquired by National City Bank, which later became Citibank, providing TCA with the financial support it needed to survive and restoring confidence in the broader market. But Morgan's work didn't stop there. He also organized a group of bankers to provide emergency funding to other troubled institutions, allowing them to meet their obligations and prevent further bank runs. Morgan personally negotiated with the Treasury Department to coordinate a national response and secure additional funds. The public response. As the crisis continued, the public became increasingly worried about the stability of the financial system. The lack of a central bank made it difficult to coordinate a national response, and people were unsure where to turn for assistance. Morgan's actions, while effective, were also controversial. Many criticized him for the lack of transparency and the perceived favoritism in his dealings. However, the fact remained that without Morgan's intervention, the panic could have spiraled out of control. His actions demonstrated the need for a more organized and regulated financial system, one that could respond quickly and effectively to crises. The aftermath. The Panic of 1907 ended with the creation of the Federal Reserve System, which was established in 1913. This new system was designed to provide a central authority to manage monetary policy and act as a lender of last resort, aiming to prevent future financial crises and ensure the stability of the financial system. How it all played out. Let's break down the key players and the timeline of events. 1. Knickerbocker Trust Company failure, October 22, 1907, Charles T. Barney's risky investments triggered a bank run. P. Morgan eventually negotiated a settlement to address the crisis, despite initial reluctance. 2. Tennessee Coal, Iron, and Railroad Company crisis. TCI faced bankruptcy due to financial difficulties. Deal to acquire TCI, which helped stabilize the market. 3. Emergency funding and coordination. Morgan organized a group of bankers to provide emergency funding to troubled institutions. He negotiated with the Treasury Department for support, though the government did not directly provide funds. 4. Public reaction and criticism. The public was wary of Morgan's actions due to a lack of transparency. This episode highlighted the need for a central banking system to stabilize financial crises. 5. Establishment of the Federal Reserve System, 1913. The Federal Reserve was created to manage monetary policy and prevent future financial crises similar to the Panic of 1907. The boring truth behind the exciting lie. Many people think that financial crises are solved by government intervention and complex regulations. P. Morgan, who stepped in and used his financial expertise and connections to stabilize the market. This demonstrates that sometimes, the most effective solutions can come from practical hands-on problem-solving rather than bureaucratic measures. Concrete facts. Knickerbocker Trust Company. Assets of $85 million, deposits of $40 million, $3 million to finance operations. P. Morgan's interventions provided over $115 million in emergency funding. P. Morgan's role in it's crucial because it demonstrates how a crisis can be managed through practical solutions. It also underscores the importance of a central authority like the Federal Reserve to prevent future financial disasters. By studying this history, we can better prepare for and mitigate future economic crises. Wrap up. So, to recap, the Panic of 1907 started with a small banking firm, the Knickerbocker Trust Company, and spread to affect major industries like coal and steel. Steel and the provision of emergency funding helped stabilize the market. This crisis led to the creation of the Federal Reserve System in 1913, which continues to play a critical role in the American financial system today. The Panic of 1907 wasn't just about money moving around. It was about trust and confidence in the financial system. When the Knickerbocker Trust Company failed in October 1907, it shook the faith people had in banks and investments. Think about it, if individuals and institutions hold on to cash instead of investing, the economy can grind to a halt. Steel were bold moves that restored some order, but it wasn't just about the big players like Morgan. Small businesses and everyday people were affected too. They lost savings, faced bankruptcy, and some even lost their jobs. The ripple effects were widespread and significant. This crisis showed the need for a central authority to manage financial panics. Before the creation of the Federal Reserve in 1913, the government lacked the tools to intervene effectively. The establishment of the Federal Reserve System provided the government with the means to prevent and respond to financial crises, ensuring smoother operations and greater stability. One key lesson from 1907 is the importance of transparency and clear communication. During the panic, uncertainty and misinformation prevailed. P. Morgan hadn't taken charge and openly communicated his plans, the crisis could have lasted longer and been more severe. Another takeaway is the value of diversification. Investors who spread their investments across different sectors and asset classes generally performed better than those who concentrated their portfolios in a single area. This principle remains relevant today. Do not rely solely on one bank or type of investment. Diversify to protect your financial assets. Lastly, the Panic of 1907 taught us the critical role of regulation. The reforms that came out of this crisis set the stage for future financial regulations. Today, rules like the Dodd-Frank Act aim to prevent another severe financial crisis by increasing transparency, reducing risk, and protecting consumers. So while the Panic of 1907 is history, its lessons are still very relevant. Understanding past financial crises helps us make better informed decisions today and avoid repeating the same mistakes. The Panic of 1907 highlighted the importance of trust in the financial system. When people lost faith in banks and the stock market, panic ensued, leading to a run on the banks and a stock market crash. Today, this lesson reminds us that trust is crucial for a stable financial system. If trust erodes, even a minor issue can quickly spiral into a major crisis. Another key takeaway is the need for a central authority to manage financial crises. Before 1907, there was no central bank to stabilize the market during a panic. P. Morgan's intervention worked temporarily, but it was not a long-term solution. After the crisis, the push for a central bank gained momentum, eventually leading to the creation of the Federal Reserve in 1913. The Fed now acts as a lender of last resort, providing liquidity during financial turmoil to prevent a systemic collapse. Moreover, the Panic of 1907 revealed the dangers of leverage and speculation. Many financial institutions and investors were highly leveraged, meaning they borrowed heavily to invest. When the market turned against them, they couldn't cover their debts, leading to widespread defaults and bankruptcies. Today, regulations limit leverage in certain markets to prevent excessive borrowing, which can protect investors from catastrophic losses. Lastly, the crisis demonstrated the interconnectedness of the global economy. Even though the Panic of 1907 began in the United States, it had ripple effects around the world. Similarly, today's financial crises, like the 2008 financial crisis, quickly spread globally due to interconnected financial systems. This highlights the importance of international cooperation in managing financial risks. Understanding the panic of 1907 helps us appreciate the measures in place today to prevent a similar financial crisis. Tomorrow on the Money Files, Inflation Basics. This is educational and historical, not financial advice.